In this lecture, I want to clarify 3 points. First of all, what is efficiency? Second, how do we assess it? And third of all, what are the main efficiency ratios? Now, what is efficiency? Efficiency is the ability of any business to actually use its resources to generate excess liquidity in the short term. In other words, we saw when it comes to the liquidity ratios that when we want to know whether a company is using its resources in the short term to produce liquidity, we actually look at its balance sheet and we look at the section related to the current assets and current liabilities. In other words, we look at the relationship that there is between the current assets and current liabilities. Indeed, when it comes to a company efficiency and also liquidity, we look at the difference between the current assets and the current liabilities, also called working capital. When the working capital for a company is positive, it means that the company can use for the operations in the short term. And that's good because remember that liquidity is usually free. It means that you don't pay any interest on it if you're able to manage your company in an efficient way. First of all, we use the inventory turnover to see how many times over we are able to turn our inventory into cash. And therefore, we want to see how many times over we are able during the year to convert this inventory in cost of sales. Now, the other actually efficiency ratio which we use is the accounts receivable in days. It allows us to see how many days it takes for us to convert our AR into cash. And the accounts payable in days, which allows us to see how many days it takes for us to clear our accounts payable. In other words, how many days it takes for us to convert our payable in actual payment to our suppliers. Now, the 3 items that we are going to look at are on our balance sheet: the inventories, the accounts payable, and the accounts receivable. And of course, we are going to compare them to 2 main items that we're going to find on our income statement: the revenues and the COGS. You have to know that when it comes to accounts receivable, those ones are connected and tied to the revenues. That's why they usually move together. Instead, when it comes to inventories and accounts payable, those are actually tied to the cost of goods sold. That's why we are going to strike a relationship between those 2 items and the cost of sales. Now, having said that, let's compute our inventory turnover, which is given by the COGS that we are going to find on our income statement, and the average inventory, which we are going to find on our balance sheet. And we are going to look at our previous year balance sheet, which is going to tell us the inventory for the previous year plus the inventory for the current year, and then we divide this number by 2, and that's how we get our average inventory. Now, another thing that we want to do, we want to make our COGS positive because we are striking here a relationship and we want to see a positive number eventually. As you can see, the final number here is 4. It means that we are actually turning our inventory into cash 4 times during the year. Now, if we want to know what does this mean in days, in other words, we want to know how many days it takes for us to convert our inventories into cash. Well, we have just to actually take 365, which is the number of days during the year, divide it by 4, which is our inventory turnover right now, and that's how we get our days, 91 days. It means that each 91 days, our inventories are converted into cash. And the more times we are able to convert them into cash, the better it is. As you can imagine, when you're a company which actually has a high inventory turnover, this is a good sign. While when you're a company which has a decreasing inventory turnover over time, this is a bad sign. And therefore, you want to look at this measure. And when this is increasing over time, it's always a good sign. Now, let's see how to use also the other 2 measures of efficiency that we have here, the accounts receivable in days and the accounts payable in days. When it comes to the accounts receivable in days, we are going to take our accounts receivable from the balance sheet, so the accounts receivable from the previous year balance sheet, and then the accounts receivable from this year balance sheet, and then we are going to divide these numbers by 2. That's how we get our average accounts receivable. And then we want to get our sales revenue, therefore the revenue generated for the year. And now this number has been multiplied by 365, which is the number of days in 1 year, to know how many days it takes for us to convert the accounts receivable in days. And as you can see here, it says almost 50 days. It means that every 50 days, we are able to convert our AR into cash. Now, remember that the AR is the money that our customers have to pay for the service or good that we already provided, but they didn't pay yet, it means that those customers bought on credit and therefore they owe us money. Now, usually an AR which goes below 60 days, it's a very good sign. It means that the company is efficiently managed. It means that the company is efficiently managed and we are able to to make sure that our customers pay. On the other hand, when the AR starts to be over 90 days, this is dangerous because it means that we have liquidity and money that we are not getting from our customer when we should actually focus on that money. If I were a company which had an AR with over 90 days, I would put an effort and an emphasis on the collection department to make sure that they are going to collect the money from our customers. Now, let's look also at our third measure here, the accounts payable in days. This is given by the average accounts payable over the COGS multiplied 365. So our average accounts payable from the previous year balance sheet plus our accounts payable, the current one that we have on our balance sheet today, divided by 2, and that's how we get our average accounts payable. And then, of course, we want to strike the relationship over the cost of sales, and then we want to make this number positive. As you can see here, we have 91 days. It means that each 91 days our accounts payable gets cleared. It means that our suppliers are giving us 90 days of time to pay for the raw materials that we buy from them. This is a good sign. When we actually have an accounts payable which goes over 90 days, it's definitely a good sign. It means that our suppliers trust us and therefore they give us more time to pay for the goods that we bought on credit. There are also cases in which the AP is less than 30 days. This just may mean that the company wants to pay right away to its suppliers, and that's really a choice of the company. But if I were a company, I would definitely take advantage of the difference in days between the accounts receivable and the accounts payable. Why? Let me show you here. So if we take our actually accounts payable in days and we do it minus to our accounts receivable in days, we can see that we have 42 days. What does it mean? It means that our customers pay faster compared to the payments that we make to our suppliers. Therefore, we have actually additional liquidity that we can use for the business operations. And when you are able to play on the difference between the accounts receivable and the accounts payable, when your accounts receivable in days are lower compared to your accounts payable in days, this is good for the company, also because this excess liquidity is free. Imagine that your customers are paying you right away and you pay your suppliers in 30 days times. It means that you're actually making business with money of your customers, and this liquidity is free. It's free of charge, it's free of interest, and you're using it to finance your operations in the short term. So that is the way to use our efficiency ratios, and that is how we can actually use our accounts receivable in days and our accounts payable in days to see whether the company is using its excess liquidity for the business operations.